Good morning, everyone. I'm Eric, and this is a Market Meridian special report. The world woke up to a different geopolitical reality today. Over the weekend, the long-simmering shadow war between Israel, the U.S., and Iran has officially burst into the light. Operation Epic Fury, the joint U.S. Israeli strike on Iranian strategic assets, is no longer a hypothetical. It is the reality of March 2026. Oil prices are screaming higher. Gold is testing the stratosphere at $5,300. But for investors, the question is this a 1973-style systemic collapse, or the ultimate buy-the-dip opportunity in a world already reshaped by AI and high interest rates? Over the next 30 minutes, we are breaking down the world map, region by region, to show you where the money is fleeing, and where it's finding a new home. This is the global market playbook. Let's start at Broad and Wall. The U.S. economy enters this conflict in a strong but complicated position. We've been riding the AI productivity wave, but this strike just threw a wrench into the Fed's soft landing narrative. The GDP to inflation tug-of-war. Before the strikes, we were looking at a 2.5% GDP growth. Now, if Brent crude stays above $100, we're looking at a 1.5% of inflation tax on the American consumer. The Fed was supposed to cut rates in May. You can take those bets off the table. Higher for longer is now higher for even longer. The stock market, it's a tale of two cities. Big tech is catching a chill because of rising yields. But look at the war chest of stocks: Lockheed Martin, Northrop Grumman, and the Permian Basin producers. They are the only green on your screen. The dollar, the greenback, is doing what it does best, eating everyone else's lunch. As long as there's smoke over the Persian Gulf, the DXY, dollar index, is the king of the mountain. The whole Europe now is in the line of fire. If the US is a reluctant safe haven, Europe is that vulnerable neighbor. After spending the last 4 years trying to decouple from Russian gas, the Eurozone now finds its energy security tied to the Strait of Hormuz. The energy shock: natural gas prices in the Dutch TTF have spiked 30% in 48 hours. If Qatari LNG shipments are blocked, Europe faces a manufacturing winter in the middle of spring. The currency, the euro, is under siege. We're testing parity with the dollar again. Why? Because the ECB is trapped. They can't raise rates to fight energy-driven inflation without crushing a fragile German industrial base. Investor takeaway: avoid euro-denominated cyclicals. The only play here? European defense contractors like Rheinmetall. They are the structural winners in a rearming continent. East Asia, as giant of traditional manufacturing, they are facing costs crisis. Now, let's turn to the engines of the East. China, Japan, and South Korea. For them, this isn't a political war, it's an input cost war. China's dilemma: 90% of Iran's oil goes to China. If those barrels disappear, Beijing has to dip into strategic reserves or pay a massive premium on the spot market. This stalls the 2026 recovery they've been fighting for. Japan and the yen: normally, the yen is a safe haven. But not this time. Because Japan imports nearly all its energy, high oil prices actually weaken the yen. It's a double whammy for Japanese households. The silver lining: East Asian tech, especially the semiconductor giants, are still the global backbone. They might dip on sentiment, but their long-term AI-driven earnings power remains intact. The Middle East and Oceania, the epicenter and the refuge. The Middle East is, obviously, the epicenter. But the financial story is nuanced. While Iranian markets are in free fall, the Gulf monarchies, Saudi Arabia, UAE, are seeing a massive influx of petrodollars. However, the risk premium on their sovereign debt is rising. This isn't just about high oil prices, it's about, can I safely sail a tanker out of Jebel Ali? And then there's Oceania, the quiet winner. Australia is the world's alternative warehouse. When the Middle East is on fire, the world looks to the outback for LNG, iron ore, and wheat. The Aussie dollar, AUD, is acting like a commodity proxy. It's the one currency that can actually challenge the greenback right now. Now, as you and me, we all need to know how to avoid the wealth trap. Before we wrap, let's talk about your portfolio. How do you avoid the wealth trap in a crisis like this? Stop revenge trading. Don't try to time the exact bottom of the S&P. Volatility is a cluster, not a single spike. Gold isn't just a metal, it's insurance. Gold at $5,300 feels high, but in a world of 2026 level debt, it's the only asset with no counterparty risk. Hold it, don't trade it. Watch the VIX. If that fear gauge stays above 30, keep your cash on the sidelines. If it spikes to 50 and starts to fade, that's when you look at the quality tech names that were unfairly punished. What is the final word from me? The bottom line is this: the world is more fragmented today than it was 48 hours ago. We are moving from a globalized efficiency model to a geopolitical security model. That means higher costs, more friction, but also massive opportunities for those who can identify the new winners. I'm Eric. We'll be here all week as the situation develops. Stay with Market Meridian Finance for the fastest data and the deepest analysis. For now, clutch your wallet, keep your eyes on the tape, and your head in the game. I'll see you at the closing bell.